Silver hit $97 an ounce. Then it fell. Oil exploded 15 to 20% in a single week, one of the biggest rallies in years. The kind of move that signals something is breaking. Here's the problem with that. When things break, silver is supposed to go up and stay up. That's the whole point of owning it. And oil isn't supposed to be the asset you wish you'd bought during a crisis. It's the asset that tells you the crisis is costing you money at the pump. This week, the playbook ran backwards. And a lot of people who thought they understood how markets behave during geopolitical shock found out they were wrong. In real time, with real money. So what exactly happened? Here's what actually happened. Over the weekend prior, US and Israeli forces struck targets inside Iran. Iran retaliated. Missile attacks, vessel bans, and a direct threat to shipping traffic through the Strait of Hormuz. Not a threat in the abstract. Tanker traffic through the strait essentially stopped. That matters because the Strait of Hormuz is not just a waterway. It's the single most important choke point in global energy supply. Roughly 20% of all oil traded in the world moves through that narrow stretch of water between Iran and Oman. There is no practical alternative route for most of it. When that passage closes, or even credibly threatens to close, the oil market doesn't wait for confirmation. It prices in the disruption immediately. Which brings us to the wrinkle that makes this week genuinely interesting, not just dramatic. Going into this, the oil market was oversupplied. Not marginally, structurally. JP Morgan had published a $60 Brent average forecast for 2026 just weeks earlier, built on a supply-demand model where output growth was running nearly a full million barrels per day ahead of demand. OPEC Plus had just approved a modest production increase for April. And when the EIA released its weekly U.S. inventory report on March 4th, crude stockpiles had built by 3.5 million barrels, above what analysts expected. The fundamental picture said, calm market, modest surplus, no reason to run. Geopolitics didn't care. The price ran anyway. That gap between what the fundamentals said and what the market did is the thing worth understanding this week, because it tells you something important about how oil actually prices risk and what happens when that risk premium eventually deflates. WTI and Brent posted their largest single-week gain since February 2022. At the peaks, daily moves were running 6 to 8%. Technical resistance that had held for months, the $76 to $79 zone, broke cleanly, with momentum pushing toward $86 to $90 on WTI and higher on Brent. On a chart, it looked like a market that had made a decision and wasn't interested in debating it. But here's what didn't change while all of that was happening. U.S. crude production was sitting near record highs, around 13.7 million barrels per day. The EIA stockpile number that came in on March 4th showed a build of 3.5 million barrels, above what analysts had penciled in. OPEC Plus had just added a modest 206,000 barrels per day back to the market. JP Morgan's global research desk, not a perma-bear outfit, had published a $60 Brent average forecast for 2026 just weeks earlier, grounded in a supply-demand model showing output running nearly a full million barrels per day ahead of demand growth. None of that changed by Monday morning. None of it changed by Friday either. What changed was something more specific and more important to understand: the market's assessment of delivery risk. Oil price isn't just supply and demand. It's supply, demand, and the probability that the supply chain between the two actually holds. Most of the time, that third variable sits quietly in the background. Traders assume oil in the ground can reach refineries, refineries can reach ports, ports can reach tankers, tankers can reach buyers. The system is assumed to function. When that assumption breaks, the price doesn't adjust incrementally. It reprices the entire chain instantly. That's what happened this week. The Hormuz disruption didn't change how much oil existed in the world. It changed the probability that the oil could move. And in a market where 20% of global trade flows through a single choke point, that probability shift is worth tens of dollars per barrel. Fundamentals be damned. The political dimension added its own layer. The U.S. Treasury was reportedly weighing direct intervention in oil futures markets to cap the spike, an extraordinary step that signals just how fast this was moving. National average gasoline prices jumped 27 cents in a week to $3.25 a gallon. And the Trump administration, to its credit, or discredit depending on your view, made clear that military objectives were taking priority over fuel price optics. No pivot toward de-escalation to protect the consumer. The market read that posture and kept running. So here's a genuine question worth sitting with before we move on. If you were standing at your desk Monday morning, if you already knew the market was structurally oversupplied, that JPM had just called $60 Brent, that U.S. output was at record highs, would you have gone long oil? Think about that honestly, because the answer tells you something about the difference between understanding fundamentals and understanding markets. Oil this week was the supply disruption story, brutal, fast, and mechanically straightforward once you see the risk premium framework. Silver is something else entirely. Because silver didn't just spike on the same fear. It spiked, then reversed, and the reason why cuts much deeper than most coverage of it bothered to explain. On March 2nd, silver gapped up to nearly $97 an ounce. Geopolitical fear flooding into metals. Exactly what every textbook on safe haven assets would predict. If you'd held silver going into that weekend, Monday morning felt like vindication. By Thursday, it was trading at $82, a $15 reversal in 3 days during an active geopolitical crisis in an asset that's supposed to protect you during active geopolitical crises. That's not a normal pullback. That's the market telling you the simple version of silver's story is missing something. Here's what it's missing. Silver isn't pulled by one force, it's pulled by 3 simultaneously, and they don't always move in the same direction. Safe haven demand is the first. Industrial demand tied to economic growth is the second. And macro sensitivity to the dollar and real yields is the third. That third force is the one most people ignore right up until it matters most. When oil spikes 15% on a geopolitical shock, it doesn't just move energy prices. It moves inflation expectations. Rising inflation expectations push yields higher. Higher yields strengthen the dollar. And a stronger dollar with elevated real yields is structurally hostile to silver. It raises the opportunity cost of holding a non-yielding asset and makes dollar-denominated commodities more expensive for everyone buying in other currencies. The same event that launched silver to $97 spent the rest of the week quietly building the conditions that brought it back down. The CME accelerated the damage. 7 consecutive margin hikes during the week, a signal that the exchange itself was uncomfortable with the leverage building in the market. When margins rise that fast, leveraged longs don't get a choice. They liquidate. Forced selling on top of macro headwinds produced a move that looked like capitulation, but was really just mechanics. What didn't break, and this matters, was the underlying thesis. Silver is running its 6th consecutive annual supply deficit. The 2026 projected shortfall is around 67 million ounces. Solar PV alone accounts for roughly 60% of industrial silver use, and that demand curve doesn't bend easily. Chinese and Indian physical buying held firm through the volatility. The structural story wasn't touched. So here's the question worth asking honestly. When silver drops 15% in 3 days during a crisis, does that mean the thesis is broken? Or does it mean you're being handed a second entry at a better price than Monday's open? The answer depends entirely on which part of the silver story you think you're trading. And that distinction between the tactical noise and the structural signal connects directly to what was happening underneath both markets all week. Because oil and silver weren't moving independently. They were both being driven by the same macro engine. And that engine is worth understanding on its own terms. An oil spike of this magnitude is not just an energy story. It's an inflation event. And inflation events have consequences that ripple far beyond the commodity that started them. The transmission mechanism is straightforward. Higher energy costs flow into consumer prices broadly. Transportation, manufacturing, food production, almost everything with a supply chain. That flow complicates the Fed's path. Rate cuts that were already uncertain get pushed further out. Real yields stay elevated. The dollar holds firm or strengthens. And every asset that is sensitive to the dollar and to the cost of waiting, silver chief among them, pays the price for a crisis it didn't cause. That's the feedback loop that explains silver's reversal without needing a single piece of silver-specific news. The oil spike built its own headwind. The darker version of this scenario has a name: stagflation. Slowing growth, persistent inflation, and a Fed with no clean move available. It's worth saying directly because markets are structurally bad at pricing it. Equities reprice growth. Bonds reprice inflation. Stagflation attacks both simultaneously, and there's no obvious hedge that works cleanly. It doesn't mean stagflation is the base case, but it's the tail risk this week made materially more plausible. There's a second-order effect on silver specifically that almost no coverage mentioned. Higher energy costs raise the cost of mining, processing, and moving silver. That's eventually price supportive. Tighter margins slow supply growth, which deepens an already structural deficit. But eventually is doing a lot of work in that sentence. In the short run, that effect is invisible. The market doesn't price it. So here's the clean line beneath all of it. In the short term, oil and silver are both hostage to the same single variable: whether the Strait of Hormuz reopens. That's it. Everything else is noise until that resolves. In the medium term, they diverge completely. Oil carries a structural surplus that reasserts itself the moment the risk premium deflates. Silver carries a structural deficit that compounds every year it goes unresolved. Same crisis, same week, same macro engine, and two fundamentally different stories waiting on the other side of it. Which raises the practical question: what do you actually do with that divergence? Tactical and structural are not the same game. Confusing them is how people make decisions that feel logical in the moment and expensive in hindsight. On oil, the tactical case this week was coherent. Hormuz risk persists, supply disruption is real, and price targets of $85 to $95 Brent are defensible while that risk stays live. If you traded the move, that's a legitimate read. But the structural case, the one that governs where oil spends most of its time once the fear dissipates, points firmly the other way. JP Morgan's $60 Brent average for 2026 wasn't a contrarian call. It was built on a supply-demand model showing output running nearly 1 million barrels per day ahead of demand. That model didn't change this week. The risk premium sitting on top of it did. When the conflict cools, the premium deflates, and the oil price doesn't gradually drift back. It falls toward whatever the fundamentals actually support. Anyone buying oil here as a long-term position isn't buying the commodity. They're buying the fear. Those are different assets with different expiration dates. Silver ran the opposite script. The tactical picture was ugly. A gap up, a sharp reversal, 7 margin hikes, forced liquidations. A brutal week to be a short-term silver trader. But the structural picture didn't move at all. 6 consecutive annual supply deficits. Mine supply that is overwhelmingly byproduct. Copper mines, zinc mines, lead mines, which means it can't be turned on in response to price signals the way a dedicated silver mine could. Solar and EV demand compounding annually. JP Morgan revised their silver average to $81 an ounce for 2026, a sharp upward move from prior estimates. The dip didn't weaken that case. It repriced the entry point. That's the framework worth carrying forward. The same asset in the same week can be a terrible short-term trade and a compelling long-term entry, simultaneously, without contradiction. The question isn't whether silver fell. It's whether the reason it fell has any bearing on why you'd own it in the first place. Know which game you're playing before the week begins, because the market will not pause to clarify which one it's running. There are two scenarios from here, not predictions, maps. The outcome depends on one variable: how long the strait stays disrupted. Scenario 1. De-escalation. Diplomatic pressure builds, tanker traffic resumes within weeks, and the geopolitical risk premium that drove this entire move begins to deflate. Oil corrects, not gradually, but sharply, because the fundamental surplus that existed before the crisis never went away. It was waiting. Prices drift back toward the 70s as the fear trade unwinds. Silver stabilizes, consolidates, and waits for its next catalyst. Yields soften slightly, the dollar retreats a little, and the macro picture returns to whatever it was before the weekend that started all of this. Scenario 2. The conflict extends or escalates. Hormuz stays disrupted past 4 to 6 weeks. Oil pushes toward $100, and beyond that if actual supply destruction sets in rather than just supply risk. For silver, this scenario is different in kind, not just degree. The first spike this week was undermined by the macro reversal it triggered. Inflation fears, rising yields, dollar strength. In a prolonged disruption, that reversal doesn't happen cleanly because the inflationary shock is too large and too sustained to dismiss with a repositioning trade. The safe haven bid and the industrial cost push thesis fire at the same time. That combination, both drivers active simultaneously, is historically where silver's largest moves have come from. Two scenarios, both internally coherent, both plausible. So here's the only question that actually matters right now. Which scenario does your current positioning survive, and which one does it require? Not which one you think is more likely, which one you're actually prepared for. Those are often different answers, and the gap between them is where most of the damage happens. Markets don't reward you for being right. They reward you for being right at the right time, with a position sized to survive being right too early. Those are three separate requirements. Most people only think about the first one. This week was a clean demonstration of that. Geopolitics doesn't file a notice before it moves price. The fundamental picture doesn't protect you from the interim. And the difference between a thesis and a trade isn't the analysis. It's the timing, the leverage, and the ability to stay in the room long enough for the story to actually resolve. Know which room you're in before you sit down. One final thing, and I mean this plainly. Nothing in this video is financial advice. It's analysis. My best reading of a fast-moving situation, built from public data and authoritative research. Markets move fast, variables shift, and the decisions are yours. Do your own work. Think for yourself.